Welcome to Homies and Houses. Today we have a special guest. Her name is Megan Chaney, and she was the lender that I used to buy my first property. So thank you so much for joining us today, Megan. How are you?
Absolutely. I'm so excited to be here. Thank you guys for having me.
Yeah, of course. So do you want to start off by telling us a little bit about like who you are and what you do?
Yeah. So, like Rachel said, my name is Megan Chaney. I'm a mortgage lender with Guild Mortgage in Bentonville, Arkansas. Um, I've been in the mortgage lending business going on about 8 years now. I've held my license for going on six. So we've kind of seen every kind of loan program and situation walk through the door. Not only is it me, but I have a team of people around me that have had combined experience of almost 100 years. So we really kind of have seen it all and are really, really focused on just making sure that everybody kind of understands what they're going through when they're working through a mortgage too.
Yeah. So like what does the process look like for if someone has never invested before, since we're a more investing focused podcast? Like where do they start? What are the steps? And what would you tell a new investor?
Yeah, the biggest thing to kind of look at when you're investing is to make sure that the first and foremost, your credit is as good as you possibly can get it. Because the better that your credit is, the better that your interest rate's going to be, the less that you're going to have to pay in points, and the less that you're going to have to put down. So anytime that you're looking at an investment property, you're going to be looking at minimum 15% and sometimes upwards to 20 to 25, depending on where you fall in that tiered credit score bracket. So, number one, first and foremost, is just make sure that that credit score is as high as it can possibly be because that's just going to open up your options on the back end as far as those down payment options go. Now, when it comes to that down payment, I would definitely say to make sure that you are planning on saving for that 25%. Even if you are qualified for a 15% down investment loan, still plan on having that 25% because that's going to give you a little bit more wiggle room on the back end. It's going to show me as a lender, hey, they have a little bit of additional assets that we can use for this loan to kind of strengthen the file overall. And it's going to show you can pay your closing costs too. So, a lot of times sellers will come in and say, hey, we'll cover some closing costs and things like that. But there's sometimes that doesn't happen. So, making sure that you have enough to cover your down payment and those closing costs is really important on the chance that the seller doesn't come in and cover that for you. So, I would just say set yourself up for the best situation where that's going to be paying all of your debts on time, making sure that you have a good revolving mix of credit. So that's going to be installment loans and revolving. An installment loan is anything that you're paying down on. So that's going to be a mortgage, that's going to be your car payments, that's going to be anything that you're paying off a balance on. Whereas a revolving line is going to be your credit cards. The best way, if you're kind of struggling with credit right now, to start that credit up is by getting a secured card. There's a lot of really good options out there. A secured card is where essentially rather than the bank lending you the money on that, you're giving them a certain amount of money and they're saying, okay, we're going to open up this credit line for you, but it's your money, so it's not as risky for the bank. That's a really, really great way to start building some of that credit, and that counts as a revolving line. So, a good mix of credit is a great way to do that, and also making sure those payments are made on time. The worst thing that you can do is miss a payment because if you miss a payment, that's staying on your credit report for a long time and it does not like coming off. So, just make sure you're making those payments on time. You have a good mix of credit and you're just focusing on your savings goals. So assets are a big thing, and so are the down payment funds. So that's going to be the biggest thing to get you guys started and to set you up for success as you're going into these investment properties. Is kind of just making sure that all your bases are checked up front with your credit score and your down payment too.
Cool. And
Thank
what
you for that.
if someone wanted to do like can someone use an FHA loan or something like that for a property if maybe it's like their first time buying an investment property?
Not necessarily on FHA. So FHA, you're kind of capped on how many properties you can. It is an option. Sometimes FHA will allow you to own more than one home at a time. But if your primary home is already an FHA mortgage, it's going to be a little bit more difficult for you to qualify for a second FHA loan while you still hold that first one. So the way that we would kind of look at that is if your primary home is on an FHA loan, we would do everything that we can to kind of flip you into a conventional loan and say, hey, this way you can hold both of these loans at the same time and you wouldn't have to pay off that first FHA loan that you have or refinance it into a conventional one just to get an FHA on your investment.
And what about, I want to go back to a credit score. So is there like, if someone is below X number credit score, should they not even like come in to apply basically until that it's above? Like, what number is that?
I would say anywhere above 720, but if you don't have a 720, don't let that take you out of it completely because what you can do is you can sit down with the lender and say, hey, here's my goals, here's what I'm trying to do, but I'm struggling with my credit. For us, we can go in and run the report, but then we can also do a score simulator on the back end where it shows us, hey, if this client does X, Y, and Z, their score has the potential to come up this many points in a certain amount of time. And the reason I say 720 isn't because you can't qualify with a lower credit score, but again, the rate bracket and where what you're going to qualify for is going to be so much better with a higher credit score than it would be if you're sitting at like a 650 or something like that. So in my opinion, anybody that comes to me, we're always going to try to set them up for success up front. So we're going to go through that. We're going to go through, hey, what can we kind of do to make sure your credit is as high as we possibly can before we go to lock in this rate, just to make sure they're getting the best deal right out of the gate. So don't let credit score kind of discourage you from having those initial conversations with your lender, but just tell them, hey, like my credit's not great, but what can I do to get there? And they should be able to help you for sure.
And then, like, if the investment property that they're looking at has tenants in it already, how does the rental income play into their loan qualification and things like that?
Yeah, so if we've had a rental history for at least a year and it's been filed on taxes and there are tenants currently living in it, we can use it as an offset to your debt to income ratio. We can't use it as income if you've never used a rental property before, and I kind of want to break down the differences there. So if we were, let's say you've had this house rented out for 5 years and you're making, I don't know, $800 a month off of that, and you're recouping that 800 and that's going into your bank account. That could potentially count for rental income for us to use, and that would definitely help as far as income goes. But if this is your first time doing an investment property, you've never done it before, we can't necessarily use that $800 that they're recouping off of the current tenants because they're not your tenants. But what we can do, since there's been a rental history, is offset it from your debt to income ratio. So we can essentially say, hey, we can prove that these payments have been made on time, these tenants are planning on living there, whether or not they are or not. We get lease agreements and all the things to kind of show, hey, this is going to be continually rented out. But rather than counting it as $800 plus your income, we just offset that $800. There's a little bit of a difference there in how we break it down on the front end, but it is definitely doable if you haven't ever had tenants before or don't have a rental history, but the property does have tenants and a rental history. It's definitely a possibility to offset that.
And can you just explain what a debt to income ratio is if
Yeah.
people don't know what that is?
Absolutely. So, debt to income ratio is where your lender is going to go in and look at all of your debts, all of your new mortgage payments, all of those things combined against your income. So, we're capped at how much we can take our borrowers up on debt to income ratio. Each loan program has a different cap on what those may be. Your most common is going to be about 50%. You don't want to go above 50% on your debt to income ratio. And when you're going in to buy an investment property, we're going to look at your current housing payment, all of the debts that are listed on your credit report, and this is monthly debts. Let's say you have a car balance with $35,000 and your monthly payment's 500. That's what we're looking at. We're looking at that 500, not necessarily that full $35,000 balance. So monthly payment on those debts is what really counts in debt to income ratio. We're taking all those monthly debts. We're taking your new housing payment that includes taxes, insurance, mortgage insurance if there is any, and then figuring your debt to income from there. Investment property, we're doing that same thing, but then we're also adding in that new investment property payment. So let's say that investment property payment's coming in at 2,000, but like we were just talking about, we know that it's profiting $800 in rent right now. That's where we're able to go in and offset some of that rental income from that $2,000 payment. So that's where it kind of helps on the back end when it comes to investment properties.
I was just talking to my lender because I wanted to refinance since rates are a little bit better right now. And he said he thought he could get it. My mortgage on one place is like 1,600 right now, down to like 1,100. I'm like, heck yeah, that sounds awesome. And then I told him that I put all my rentals in a separate LLC to like protect myself. And he's like, oh, that's great. That should help the debt to income ratio. but then he came back and they haven't, only one of them has been in an LLC for over a year, I believe is what he said. We just kind of had this quick text conversation. So, do you know about that? Like, after my LLCs are established for over a year, then can we take that out of debt to income ratio?
Essentially, yes. So, kind of the rule of thumb there, 2 years in mortgage lending is kind of the rule of thumb because 2 years is going to help us average out anything. But there are some loan programs and some investors that will take an LLC for a year. So, that's kind of where we get into some of those one off programs where we look at different investors and see what they have. Like, for example, a bank statement loan would be with a different investor. It would be the same type of thing with an investment property like that, where, hey, I've had it in an LLC for a year. Maybe it wouldn't qualify for a standard conventional loan, but what other investor options do we have? And that's what we could kind of look at there. So it really just depends. And there's pros and cons to doing that too. Sometimes those investor programs, they're going to be the ones that are going to make you put 25% down, and your interest rate's going to be a little bit higher, but it does allow you to do that. It does allow you to get into the home, and then we can always refinance it. So, yes and no. The rule of thumb: if you can have 2 years on that tax return, that's going to be best case scenario. But if you do just have the one, that's totally fine. It's a lot harder for us to work with it if you don't have a full year. So having that full year, at least a year, is really really important to be able to use as income, I should say.
Gotcha. Yeah, I just bought a triplex in November, and I think it helped a lot that there was tenants that have been in there for 14 years
Definitely.
in one unit, 12 years in another,
Yeah.
and one of them was newer. But
Yeah. And we
yeah,
definitely look at that on our side too, and we say, hey, oh, this has a really good likelihood of continuing to be rented out because it has such a strong rental history. So that does definitely play a factor in what we can do on the qualification side too.
So how does someone go about getting pre-qualified?
Yeah.
And is
The
there a
best
difference between pre-qualification and pre-approval?
For sure. So, best case scenario is to start with a local lender. A lot of times, online lenders will make a lot of promises up front, and then you get your loan estimate, and it does not look anything like what they told you it was going to be. I was working with a client this week, and she had sent me, I'm not going to say the company name, but it was an online lender, and she had sent me the approval, and I said, okay, great. Can you send me that estimate that he sent you with all of, the numbers broken down? And he sends her back an email, and it just has her rate, no APR associated, and that's your annual percentage rate. So there's a difference between your interest rate and your annual percentage rate. Your interest rate is what you're paying on monthly. That's going to be your 6.5, 7, whatever. But then that APR, that has all of your fees associated with the loan broken down into a percent. So that's going to tell you right out of the gate what you're being charged for on the backside. So if a lender is giving you a quote and it does not have an APR attached to it, it does not mean anything, and it's not exactly legal for them to do that. So going further down there, he kind of listed some like ballpark fees that he thought. That's not a real estimate. That doesn't mean anything. And on cash to close, he just had TBD. If y'all are getting estimates like that, please, please, please go to a local lender and have them sit down with you and look at your file, because this is what we do every day. We sit in our office and we go through things like this, and we want to work with you. We want to help you. You're not just another number that's in our system. So kind of watch out for that. Make sure you're using somebody that's reputable, somebody that you know, someone that you can go in and say, "Hey, can you look at this?" Or at least be able to pick up the phone and call them and say, "Hey, can you work through this with me? Let's hop on a call," something like that. Who you work with on the front side is really really important. Don't get caught up in the gimmicky, "Hey, we can get you a 4.99%," because you're probably paying for it somewhere. I can guarantee that. So just make sure you're working with somebody who's really reputable and knowledgeable up front when it comes to that. Circling back, what was the original question?
difference between pre-qualification and
Qualification and
pre-approval.
pre-approval. Yes, okay. So sorry. The difference between a pre-qualification and pre-approval is a pre-qualification is basically you calling me and saying, this is how much I make per year, this is what I think my credit score is, and these are where I think my debts are at. That's me kind of getting in my head a ballpark of what I think you can qualify for, and I'm going to say, okay, cool, I think you can qualify for this amount. That's a pre-qualification. Qualification doesn't mean a whole lot. A pre-qualification is just saying, hey, I've talked to a lender and they think that I'm going to be good for this amount. Whereas a pre-approval, I'm going to look at all your documents. I'm going to look at your income docs. I'm going to look at your credit score. I'm going to look at your assets, your bank statements, all of those things, and then be able to kind of really go through and say, hey, we have a prelim underwriting approval on this. We've run the file through our system. We got the approval. We're good to go. And then kind of move forward from there. So a pre-approval is a lot stronger than a pre-qualification. And yes, a pre-approval is going to take a little bit more time, but it's a lot better to go in with that pre-approval than go in with the pre-qualification, go under contract, and then something happen because your documents haven't been vetted on the front end. So that would definitely be my biggest piece of advice is just make sure you're working with a lender that knows what they're doing and that's actually taking the time to look through your documents and tell you what you're qualified for.
Just
I
having a
can't
relation.
imagine, sorry,
Go
hold
ahead.
on. I can't imagine using an online lender.
Yeah. Well, it makes it hard. It makes it harder on your realtor and the title company too, because you're kind of whenever you call in to some of these companies, they're just sending you to their service team and they have not really any idea what's going on. It's hard for you to actually talk to the loan officer for title company and the realtors, they're like, who do we reach out to for this stuff? What do we do here? So it's just they like I said, they promise a lot up front, but it doesn't always stick in the back end. So I would always recommend at least having a real person that you kind of have seen their social media or have talked to them on the phone. Something like that is going to be a lot better than an online lender.
Not to mention, relationships are so important. Me and
Yes,
Yeah.
Rachel were
for sure.
talking about that before. So just like
Yeah.
while we're on the topic of like using someone you know, or that's local at least, can
Mhm.
you talk a little bit about the importance of the relationship that's built between an investor and a lender?
Yeah. I think that's the biggest thing. When Rachel and I first sat down to do her loan, that was one of the first things she said. She said, "Hey, eventually I want to start investing." So that's when in my head I'm like, "Okay, I know what those goals are." That's what you want with your lender. You want to establish that relationship up front because investing, if you're wanting to be an investor, you're probably not just going to want to buy one home. You're kind of want to going to build out this investment portfolio, and if you're working with one lender that has all of your documentation and knows what's going on, that's going to make it a lot easier on the back end. Not to mention, we're already going to have a lot of your information and we're going to be able to know what loan programs are going to be best for you. Because eventually, what you could potentially do is roll these properties into what's called a DSCR loan, and that's a debt service coverage ratio loan, where rather than looking at your income or all these other things that go into qualification, we truly just look at how much you're making off of these rental properties, and we're able to just roll equity into those properties as you build your rental portfolio up. So that's a really great option once you kind of have a portfolio of a couple rental properties that you want to put together into a single loan and just roll your equity over.
Cool. Yeah, me and Megan met at a women in networking event. And I strongly recommend doing stuff like that, or at least calling a few lenders before you make a decision, or even before you get started in investing, because it's nice to like talk to lenders and kind of just get an idea what the market is like and what kind of things they're going to need from you. And um, yeah, maybe some things that you shouldn't do if you're planning on getting a loan for a house. Megan, any recommendations of things not to do if you're about to apply for a loan?
If you are trying to apply for a loan, please do not go buy a $60,000 car with a $700 or $800 monthly payment. That is going to tank your debt to income ratio. The biggest thing too that we see is people go into this and they think, okay, great, well now I'm about to buy a home, so obviously I have to have furniture. They go finance that, and that happens in the middle of their transaction, and that can definitely throw off your debt to income ratio, and then you're potentially not getting the house. Protecting that credit and not opening up any new lines is really, really important. And having that debt to income ratio as low as possible is really, really important. If you've got credit cards out there that have a $5,000 balance on them right now and you're maxed out at that 5,000, start working on paying those down. Get them down to about 15 to 10 to 15% is a pretty safe bet on the balance that you need to hold. So as long as you're not going over that, your usage is going to stay down. You're making those monthly payments. Credit is it's pretty complicated, and when you make a mistake or miss a payment, it does stay on there for a while, but it also is really easy to get on track with your credit again. Auto draft is a great option. I know for me sometimes I'm like, oh, I had that credit card payment that I was supposed to make today. Need to go pop back in and do that, and then you're hit with a $40 late fee on top of it. So auto draft is a great way to prevent any of those missed payments from coming out. So try to make sure that you're set up for that. And then, like I said, just put back as much as you can for savings, and be as prepared as you possibly can be on that end as well.
I think what some people need to be, and you can speak more to this, need to be aware of is like when I first buy a property, I feel like so my credit, I have a good credit score. It's almost 800. It's like 770 or something like that right now. But when I buy a property, it seems to like go down a little bit and then it catches itself back
Yeah,
up. Is that correct?
100.
Is that why it's going down? Yeah.
Yeah, and the cool thing about mortgage lending too is most lenders are going to give you 30 to 45 days to shop around for different rates. So if you're out there and you're like, I don't know any local lenders. I don't know what I'm supposed to do here. That's when you can go in and interview them. That's when you can sit down and say, "Hey, what do you think I should do here? How does this work? What is your process like?" Get a feel for your lender, because if you don't like your lender, you're probably not going to like going through the loan process. So sit down with them. And why I say that is because they give you that window of opportunity to go in where anytime your credit's pulled, it only counts as one inquiry on that report. It's not like going to a car dealership where they're pulling your credit through 11 different companies and it's a separate credit hit every single time. So you are going to get an initial drop because every credit inquiry does come with a little bit of a drop. But as you start making those payments and you make those payments on time, your score is going to overcompensate for that drop because it's going to come up so much because you have a new installment loan that you're paying a big balance down on. So as you start making those monthly payments regularly, that score is definitely going to readjust and come up as well.
Cool.
So we had a question come through Instagram. A few of these were on Instagram, but this one is a little bit, I just want to get it right. So hold on. All right. How do you feel as a lender about a statewide or nationwide fixed rate for each tier of mortgage, like a 20 versus 30 year? So, for example, they're saying like if all 30-year notes were 5%, and then mortgage lenders would compete for business based on fees. What do you think about that?
I think there are a lot of issues with that. Number one, because not everybody makes the same amount of money. So if let's just use a 30-year mortgage for example in this situation. So let's say everybody has a 30-year mortgage at 5%. So this 580 credit score borrower that has 60 grand coming in income, there's nothing wrong with that, but he's paying 5% interest on a 30-year. So is your borrower that's making 180 grand and has an 800 credit score, they're paying 5%. That doesn't necessarily equate. It's kind of think of it like taxes. I know I'm not trying to get into the whole politics of it all, whatever. But the reason that we have different brackets for that is because it ultimately always is going to protect the investor or the lender. So the investor that's giving you that note rate is who is setting that note rate. They're deciding how much risk they're willing to take on. So don't think of it as like there's this one big government pool of money that's funding all of these loans. There are so many different investors that we can choose from. They're the ones that are competing for the rates. Those are the ones that are coming in and saying it's the PennyMacs, the AmeriHomes, the U.S. banks, all of these big companies that are coming in and competing for those rates. So they're going to say, hey, 800 credit score borrower, that's a lot less risk than this 580 credit score borrower. They also have a lot more income. They don't have quite as much income. Which one is more risky? Your less risky borrower is going to get a better interest rate than your borrower that carries a little bit more risk. So that's one of the reasons that they do that. It's to protect the investor at the end of the day. So there's not really a way for them to come in and say, yeah, would that be an ideal perfect world? 100%. Yeah, but the investor also has to make money. The lender also has to make money. There has to be a way for that to be built in, or else they wouldn't have the money to loan out on this. They wouldn't have the money to fund these loans. So they have to make money on the back end, or there wouldn't be any. I know that probably, I know that's a multi-layer question, and I'm just trying to answer it as generically as I can, but that's essentially what it boils down to. The investor sets the rate, they evaluate the risk, and they decide where that's going to come in. Now, I say the investor sets the rate. Overall, the Fed is who is kind of, who controls rates, all the things, but there's a lot that goes into what makes up a mortgage rate. Mortgage rates are very tied into the 10-year treasury bond, so that is kind of what dictates where rates are going. US Bank can't just go out there and say, oh, hey, we want the rate to be 7% today. No. They're still basing it on what the government and the Fed is saying, and they have caps on how high they can charge things and how high their rates can go. So they're competed at a whole different level. Yes, the Fed does come in and say, hey, these are your parameters that you have to follow, but the investors have to make money on the back end, and that's where that competition for those rates come into play.
Yeah, that makes sense to me. I wasn't really sure when I first read that question, so I'm glad it was asked. I'm glad it came through, but I'm the investor. I don't know all the ins and outs of your position. So,
Like I said, I could probably talk on that one for a lot longer, but you know, with all the things.
well, actually, so is there a way that our listeners can like reach out to you? Do you have like an Instagram or any social media?
Yeah, absolutely. So you can follow me on Instagram. It's just mortgages with Megan C. So all one word, just my first and then my last initial. Um, it's my personal. I kind of combine my personal and my business page together. So there's that, and then you can also follow me on Facebook as well. It's just Megan Chaney. I've got my personal page set up to be able to follow, and then my business page as well. I do have a TikTok. It's I believe it's just Megan underscore Chaney, but I don't use it a whole lot. So Instagram and Facebook would be the best way to reach me, or you can always email me at mchaney@guildmortgage.net.
And then what is one step someone can take this week to move closer to investing
I would
as a
say
kind of sign up?
definitely map out what you want that to look like. Look at your income and look at your budgeting. Look at how you're spending your money right now and how much extra you're able to afford. Realistically, so yeah, like I said, we can go up to 50% on debt to income ratio. Can you go up to 50% on your debt to income ratio? That's kind of the question. So really kind of dive into what you can afford. And if you're looking at that, say, hey, I'm about to look at buying this investment property. How much do I need to net as an investor to make it worth doing this for myself? How much do I need to charge them in rent on top of all of my other things that I'm paying, on top of all of my subscriptions, my insurance, everything else? Take into consideration, really break down every single thing that you're being charged for on a monthly basis, because when you do that and you write it all down on paper, I guarantee you're going to kind of be surprised at how much you're spending every single month and on what. So that's definitely one thing that you can do to really get it started, is just look at those debts, look at where your credit score is, look at how much you've got in the bank, and say, okay, what can I do to make any of these situations better, or what can I cut out to maybe pay off some of that debt? Can I cancel my Hulu subscription that I'm paying live TV for and it's $120 a month? What can you cut out to kind of pay down some of that debt that's going to benefit you in the long run?
Yeah, like looking at like what you want long term more than just short term. And I
Exactly.
think that's the real key to those who succeed and those who don't in investing
100%.
is delaying that instant gratification for what you want long term.
Absolutely.
Awesome. Well, thank you so much for. Do you have any more questions, Rachel?
No, that's it.
No.
Yeah.
Yeah, that was amazing. Thank you so much for being here. It was so nice to meet you.
Absolutely. Thank you guys for having me on, and I will be talking to y'all soon.
Cool.
All right. See everyone next time.
Bye.